Hi everyone, welcome to Buzz Crimson. My name is Shakib. So I'm relaunching the option trading video series. This is the part 1. If you're new to option trading, you really need to watch this video thoroughly. It's going to give you a significant advantage over any other new option trader. And if you've been trading options for a couple of months and you want to just touch up on your basics, then please use this video to review. Okay, so I'm going to give you the whole presentation file in a Google spreadsheet. There's 2 ways you can speed up your learning process from the video and the PowerPoint. Use the chapter tool in the video. If you feel like you know something, just skip through. And in the spreadsheet, not a spreadsheet, it's a PowerPoint Google slide. Use this page, video chapter topics, to click on these boxes. It'll take you directly to that topic, so you don't have to flip through the pages, okay? So that's pretty much how the video will go. Before we move on to the topics, don't forget to subscribe so you can stay tuned for the upcoming videos, and smash the like button, because you're not going to see this in any other channel where everything I show you, I give it to you out for free. I mean, who doesn't like free stuff, right? So, all right, let's get started. Let's start with what are options and why. So options are just contracts. The contract is based on an underlying security. So if you buy a Microsoft option, the option contract is based on the Microsoft stock. Simple. This option contract is going to allow you to buy Microsoft shares or sell Microsoft shares at a certain price. Okay, we're going to go over all of that more in depth in the next couple of slides, but there are 2 reasons why people trade options. Number 1, to generate income from speculation, but using a significantly less capital compared to just buying the shares and then, buying the shares cheap and then selling them at a high price. You can always do that, but it takes a lot more capital when you compare it to just buying the option, because the option is significantly cheaper. And then to hedge or protect your investments, if you own a lot of shares and you believe the stock might see a sharp decline in price, you can always buy option contract to protect your investments or hedge, essentially reduce loss in the event of a sharp decline in price. And I'll show you a lot of detailed example later in the video. Okay, so here's an option ticket example. Okay, we're going to go through all of these elements later in the video, but I want you to get familiar with how an option ticket looks like. So here's 2 examples from 2 different trading platforms. Thinkorswim by TD Ameritrade at the top and Robinhood in the bottom. They're both representing the same order. But yeah, so Thinkorswim is a full-fledged trading platform. They show a lot of details. Okay, so let's go from the left. We have order type. In this case, this is a buy order, so it says buy. Remember, you can buy and sell option contract, so buy. +1 represents your buying, so +1. If I was selling it, it would be -1. And 1 is the quantity. 1 option contract in this case, but each option contract controls 100 shares, commands 100 shares. So that's why you're seeing this 100 here. In Robinhood, it doesn't show you the 100, but it applies in everywhere. So ticker is Microsoft. Option themselves don't have a ticker, but the underlying stock decides what the ticker will be. So if you're buying a Microsoft option, then you need to go to Microsoft first and then find the options. So options by themselves don't have tickers. All right. Then you have an expiration date. Contracts, they expire. I mean, unless you're talking about, yeah, there are contracts that never expire, but for options, you always have an expiration date. Okay. So in this case, this is the expiration date. Now, strike price. Try to think of, I'm going to use the analogy of insurance. Let's say Geico. When you buy insurance from Geico, let's say, just because I paid for insurance doesn't mean I can claim it all the time, every day. I can only claim something when I get into a fender bender, right? That's when I say, I got in an accident, I'm claiming it. In this case, the strike price is similar to that. You can think about it as a trigger price or claim price. The Microsoft stock price would have to go to that strike price, touch it, or go above for this, whoever's buying this contract to be in the play, in the money, so they can start claiming on exercising, however you want to call it. I'll show you all those terminologies later, but just think about strike price as the trigger price for an option. And then we'll talk about option types later in the video, but essentially this is a call option. This type of option is called call option, okay? In the bottom, same story, just presented in a different way. Okay, let's go. So a little more detail about what we saw in the last page, share price. These are the things that you're going to see. You're going to need to know when you trade an option, okay? Share price. In the example I used, Microsoft share price is the share price. Option price. So option has its own price. Let's say an option price is $2, but remember, it commands 100 shares. So $2 times 100, $200. That's the price you're going to have to pay to buy that option contract. Strike price, as I mentioned, trigger price, claim price. I want you to look at this. The reason why I was able to see this contract available for buying is because someone else is willing to sell it. And that person chose this strike price. Now, if I bought this option, I would also choose this strike price, right? So it's chosen by the buyer and seller. There's always someone else on the other side of the table. Exercise, claiming the contract's agreed upon right. If the contract says I can buy the shares at a certain price, that's it. If it say I can sell it at the strike price, that's my, agreed upon right because I paid for it. Assign is essentially fulfilling the contract's agreed upon duty. So if you go here and see that if I bought this, I would have the right to buy Microsoft shares at $202.50, even if the share price was $250 or $300, right? But someone sold this to me, so that person has the obligation to sell Microsoft shares at this price, even if the stock price is at $300. They would take a loss, but remember, they got paid for this, right? It's kind of like insurance, right? You pay your premium. So if you get into a fender bender, the insurance company has to make sure your car gets fixed, no matter how much it costs. So similar. And then premium is, it's actually funny that in option, when you pay to buy an option, the money that goes toward the seller, it's called premium, just like insurance company. It's very similar, so I'm going to keep using that example. Okay, let's go to more option facts. So option prices, how are these decided? They're not very static, so they will change. So they depend on three different things. The underlying security's share price and the strike price. So where the Microsoft's stock price is in relative to the strike price is a huge factor in options contract price. And then also volatility, how volatile the stock is. The more volatile it is, the more pricey the option will be. And then how long do you have till expiration? I'm going to refer to the same example. If you have 300 days in car insurance, you have a long time to claim something. In next 300 days, any day you might have an accident or something, a fender bender, and you can claim, as opposed to an insurance policy that expires 2 days later. You have a smaller window to claim. So the one that has more days is going to be more expensive, right? So the option that has a lot of days till expiration is going to be more expensive. Okay, so options can be traded or exercised anytime up to and including the expiration date. Okay, now here's the terminology: buy and close. Okay, traditionally, if you just buy shares, you're buying the shares to open and then selling them to close. In option, you can buy to open and sell to open. Okay, if you're buying to open, then selling to close. If you're selling to open, then you're buying to close. If you're selling something you don't have, you need to replace it. How do you replace it? By buying it back. Okay, So the second one I already mentioned before, the last one I mentioned before, options command 100 shares, only at a fraction of the price. And then lastly, selling option. When you're selling an option, it's going to require collateral because you're selling something that you don't have. So you need to secure that with something. You can secure that with the shares, the underlying shares, or with cash. All right. I don't think you have to worry too much about that for now. I'll show you some examples later on about this. Okay. Types of options. We're finally here. So there are only two types of options: call option and put option. Here's a cutout from a very popular stock, PLTR, Palantir. As you can see, there's 4 scenarios. You can buy or sell a call option. And then there's the other type of option. It's called put. You can buy or sell a put option. Okay. When you just buy a contract, that's a single leg option contract. When you sell an option, it's a single leg option contract. However, if you want, you can buy and sell option contracts simultaneously. There are strategies where you buy and sell up to 4 option contracts. Those are multi-leg option spreads. You're not going to have to worry about that if you're a new investor. It's really important that you understand how single leg option contracts strategies work, and then you can move on. If you understand how single leg strategies work, multi-leg will be easy for you. Okay, so we're going to start with single leg for now in this video. Okay. All right, so as I say, there's only 4 type of orders that can go: buy and sell for a call, buy and sell for a put. So a very good way to explain that is through a matrix. Okay, so we got call option and put option, and the 2 scenarios: you're buying a call option, you're selling a call option, you're buying a put option, selling a put option. Okay, notice the keywords right. Okay, I should underline this, but essentially when you're buying a call option, you are paying to get the right to buy the underlying shares at the strike price. Okay. Similarly, just read through the rest, but essentially whenever you're on the buyer end, you're paying to get a right. When you're on the sell side, you're essentially getting paid to earn an obligation. And if the option becomes in the money, you are going to have to meet your obligation by either selling your shares or buying something from the buyer. The color scheme here is going for a bullish and bearish objective. So if you were a bullish investor, you would, for a single leg option strategy, you would buy a call or sell a put. If you're bearish, you would sell a call or buy a put. We'll go over that later, but this will help you in the future. Okay, so here we are in the money, out of the money matrix. I keep mentioning those terms in the previous slide, so you need to understand them. Essentially, when an option becomes in the money, its price starts to go up. When it's out of the money, its price stays relatively cheap compared to an in the money option. Okay, so since we have call and put option, I laid out the scenarios where a call option is in the money or out the money. It's all about where the stock price is in relative to the strike price. Okay, so let's go over the first one: call option in the money. So if the stock price at least reaches the strike price or goes above, it's in the money. Okay, and so that means it'll start going up in price for the option. So let's look at an example. Okay, so right now we're looking into Apple, and the Apple's share price is at 125, let's say 126. So as you can see, strike price is this column. This is Robinhood. So these are strike prices. Notice how the strike prices that are under the share price, under 126, their prices are significantly higher than the strike prices that are above. What is this? Oh, sorry. What is this equation? The stock price needs to be higher or equal. So all the strike prices that are above the stock price, those are out of the money. So as you can see, the ones that are out of the money, they're significantly cheaper compared to the ones that are in the money. The deeper in the money you go, the more expensive it is, because this one, these are way easier to claim. In fact, these will be so much easier to claim or exercise compared to these because they're already in the money. It's just, that's how it works. Okay. I'll take you through what break-even price means, but for now, just think about in the money, out of the money. In the money means you're in business. Okay. It's great for someone who bought the option. It's bad for someone who sold the option because there's a high chance that whoever sold the option is gonna, they're gonna have to do what they agreed they were going to do in the contract. Okay. So, oops, I keep going to the wrong tab. Okay, so same story with the other one. Just, get yourself familiar with how something becomes in the money, out of the money. This image should help you to understand where the stock price will be relative to strike price to make an option contract in the money or out of the money. Okay, the color scheme should help you as well. All right. So as I mentioned, when you're buying an option, there's definitely someone else on the other side who's selling you that option. So this matrix should help you understand what's happening. Okay. So I'll take you to the call option from the buyer perspective. So when you're in this page, try to go through this like this. For call option, just go through buy side and then immediately check out the sell side. So for call, if I'm buying it, I'm paying to buy the option. And because I'm paying, I am getting the right to buy the underlying shares or exercise at the stocks. Like I will get to buy the 100 shares of that underlying security at the strike price. Okay, if it's in the money, it's so whoever is getting the money that I paid to buy the option, that person is the seller, right? And because he got paid, he's obligated to sell those shares at the strike price if I exercise it. Okay. Same story here, but just different objective. Again, I color schemed it so you know that this one is a bullish objective. This one, I would buy a call option if I'm bullish. I would sell a put option if I'm bullish. Vice versa. Okay. So options intrinsic value. This slide is really important because this will essentially open your eyes toward what a lot of people do. When you hear Tesla calls, people who made millions from Tesla, GameStop, and all this stuff, this is what they do. They don't buy shares. They trade options. Okay, so essentially, options intrinsic value helps you understand how much profit currently exists. Based on how in the money and out of the money the option is, right? So how do you calculate it? I laid out the formula for you there, but essentially all those three things that I mentioned that factor the impact option price, those are baked into the option's own price. So what happens is a lot of investors, they never exercise options to buy shares or whatever. They trade the option as a security of its own because it is its own security. It's a derivative security. So what they do is if they're bullish, they buy the call option, they go long call. And then if the stock starts to go up like they speculated, they don't exercise to buy the shares. Whatever price movement the stock is experiencing, if it's going up, the option, a long call, will also experience price increase. So they just sell the call option to capture profit. They don't even care to exercise. You're going to see a lot of videos on YouTube where they'll say, what are you doing? Why are you exercising? Just trade the option. I'm telling you, if you exercise and put up the capital to buy the shares, you're going to end up with the same profit. So why exercise? Just trade the option like it's a stock and capture the profit. And that's what a lot of the investors do because very few people actually have. You're going to see a lot of people trade Tesla call options, but majority of them don't have the capital to buy 100 Tesla shares. right now, I think if you want to buy 100 Tesla shares, you're going to have to pay probably like $70,000. But you can buy a Tesla call for probably a couple of $1,000s. So fraction of the capital, right? So that's how it is. All right, so we're now looking into the bid and ask spread matrix, okay? So if you're confused about what it is, if you're not sure, read through the first paragraph. But essentially, you need to know how to price your, how to choose the proper limit price to make sure your order gets filled. And yeah, essentially, you want to make sure that you choose a good price for opening and closing your trade. A lot of people struggle to get their option orders filled because they choose wrong limit prices for their order. So if you look at this matrix, it should help you to understand how to get your orders filled, how to pick a good price, so that you don't feel bad about, oh, I paid too much, or I didn't get paid enough to sell something. Okay. A good way to think about this is think about a house buying experience. This will help you understand how to choose the which way to rely, move to pick the better price. Okay, so let me show you an example. Let's go to Apple. I don't know, something like here. Okay, so let's say I want to buy this. I click it. All right. Okay. So for some reason, this is okay. There we go. All right. So I want to buy this call, and when I click it, it's showing me this range. This is the bid and ask spread. 515 is the maximum price someone who's trying to buy is willing to pay, or see, it's changing all the time. And this is the high minimum price sellers want to receive. Okay. And what you're seeing here is they usually auto-populate it as a price that's kind of in the middle. If you submit a long call order at, let's say, 515, what's going to happen is the order might fill. If it doesn't, then you're going to have to decide, you have to know how to work with the bid and ask spread to fill your order. Okay. So let's say this was an Apple. This was a house buying situation. I'm a buyer and I'm going to the seller and say, what is the asking price, right? Because the seller is going to ask for a certain amount of money to sell their house. So as I said, bid and ask. So this is what the seller is trying to receive from me for, if I want to buy this. So I need to get closer to this price in order for my order to get filled. Okay. So if I submit it at the mark price of 515 and the order doesn't get filled, and I'm like, oh man, I really need to buy this. What I need to do is I need to say, 516 and send the order. If it doesn't work, then I need to get closer. The example is might sound a little weird because this bid and ask spread keeps changing as the market's open right now. But essentially, if you're buying, you need to get closer to the ask price. And if you're selling, you need to get closer to the bid price, because when I'm selling a house, I go to the buyer and the buyer goes, all right, I'm going to bid now, and I'm going to bid at this price. So think about it. This matrix should help you to decide which direction you need to increase your price or lower your price. Okay. Time for examples. Okay. So bullish long call example. As you remember, you should remember that when you're bullish and you are thinking the stock will go up, you can do two things for single leg options. You can buy a call or sell a put. So we're going to go through the call situation. Okay, so ARKK is a very popular ETF from ARKK. It performed really well last year. So let's go to the example scenario. So let's say its price today is $148. I wrote this a couple of days ago. It might not be relevant because of what happened recently with the market, but let's go with this example. So ARKK price today is 148. My goal is to buy ARKK shares cheap or low and then sell them at a higher price. That's how you make profit, right? Traditionally. So I'm speculating that last year ARKK saw like 100% gain. So I believe this year it'll go close to, you know, similar performance. So it'll reach $200. It's at 148. It's only got to go up like $52, you know, and I think it'll do that by the end of this year. So I'm speculating. So what I can do is, obviously I can just buy the shares today at 148. So I would have to spend $14,800 today to buy those shares. However, if I don't have that amount of capital, I can turn to options. Okay, so what I can do is buy one long call, and I did that. Here's an example. So I bought a long call. The strike price is $152.96. Okay, so if the ARKK stock price reaches this strike price or goes above, I'm in the money. I can exercise. Okay. As I mentioned before, as this stock price keeps going up and gets closer to this or goes above, the price of the option will explode because it is in the money. Those are more expensive, right? So just remember that. Okay, so I paid $2,590 to buy this call option. And I got a long time because I assumed that I speculated that the stock price is going to go to 200 by the end of the year. I picked an expiration date that's January 21st of next year. So I have a lot of time. Okay, so I bought it. I forget about it. ARKK reaches $200 in somewhere around mid-December. Okay, so, you know, got like a month before it expires. It's in the money, you know. I mean, it was in the money for a while and it reached 200, and that was my goal. I wanted to, you know, cash out at 200. So when it's at 200, so since I own this call option, I have two options, two choices. I can either sell the call option or I can exercise to buy the shares. So let's look at both situations. If I just sell my long call or, you know, sell it to close, at that time the option has a value. The option price is $39.17 because it is so deep in the money that it's just much more expensive than what I paid for. So I sell it at $39.17 or $3,917 credit. Okay, because I'm selling it, I'm getting it, so it's credit. When I bought it, it was debit. So my profit is I paid $2,590 and I sold it at $39.17. So my profit is $1,327, which is about 51% profit on the amount of money I spent to buy that option. Okay. Here's a link that you can click and it'll take you to that trade. So as you can see, this is a tool from Option Profit Calculator. So let's say around December, we don't have the 200 price here, but we can look at 201 around December. It was about $1,309. That's profit. But when you look into the option spread value, right here, it was about $39. And how much I paid? I paid $25.90. So it increased in value because it was in the money. I sold it and I captured profit. Now, I could have exercised because it was in the money. If I exercised it, the seller who sold that call option to me would have to sell his 100 ARKK shares at the strike price. Even though the stock was trading at 200 something, he would have to sell those ARKK shares to me at $152.96. Okay, so but I would have to have that money to buy those shares, right? To exercise, I have to have the capital to exercise. So I take out my wallet and pay $15,296 to buy those shares at a discount, significant discount. Okay, so at that point, my effective cost of buying those shares would be $1,296 because that's what I paid, significantly discounted, but I paid to buy that option. That option allowed me to buy these. So the price I paid to buy those shares plus the option price that I paid. So that's the total. So if my goal was to sell the shares at $200, so if I sold them after exercising, my profit would have been only $2,114. That's about 12%. I guess that's about 12% profit compared to how much capital I invested, which is like which is about $1,886. So as you can see, there's a significant advantage in just trading the option as a security, right? Buy the option at a low price, sell it at a higher price. Sell the option at a low, high price, and then buy it back at a cheaper price. That's what most investors do. Okay. All right, moving to put options, okay? In this case, we're looking into two bearish examples. Remember, as I mentioned, a lot of people trade options to hedge. So for put option, I'm going to show you speculation example and hedge, okay? So first one, speculation. We're looking at Apple. Price today, when I wrote the example, price was $125. In this example, I do not own any Apple shares, okay? So my goal is to profit from possible, if I'm bearish, I think the stock will go down. So my goal is to profit from possible decline in Apple's share price. I don't own Apple. I don't want to own Apple. I just want to profit from declining share price. Okay. So my speculation is Apple will fall to 120 or below 120 by the end of this year. So what I can do is I can buy a put contract, put option, with a strike price of 120. Okay, it's going to expire in May 1st of this year, and I paid $630 for it, debit. So let's say Apple reaches $108 in April, still got a month, and I decide to close my position from, off my speculative position. Since I bought to open, I'm going to sell to close. Because Apple price declined significantly and my put option became in the money, the price of the option increased significantly because it's in the money. The option, when I was selling it, it was priced at $13.59. So I captured $729 profit. That's about 113% profit compared to how much money I had to invest to buy that option. Here's a profit chart. You can always click this link to see how the trade works. Since this is a put option, in call option, the upper part of this chart would be green, but in a put option, since it's a bearish strategy, the green part is in the bottom because I will profit from declining share price. So what I said was it reached 108 on April 10. So 108 is somewhere right here, April 10, right there. The spread was $13.76. So selling that, I captured a lot of, there's a little bit of difference in the spread price because it's that this chart is showing you prices based on the current market situation. I wrote this example a couple of days ago. But essentially, here it is. I speculated that the price will go down. I bought a put. I was right, and I got rewarded significantly. If I tried to do that by buying the shares, I would have to short the shares. But that's very risky compared to this option trade, where my maximum loss if the Apple shares did not decline in price would be that $630, worst case. Okay, now we're gonna look at an example for hedging. So again, Apple Price today is 125. In this example, I do own 100 shares of Apple, okay? And I bought them today at $125 each. So I paid $12,500 to buy 100 shares today. Now, my goal is to make sure that I don't lose money in the event of Apple shares dropping below 115. Okay, so that's my 115. That's my worst case scenario. I don't want to own shares after that price. However, you know, if I can always put a stop loss at 115, but that's that. But I want to reduce my losses, and this is how I can do it. I can buy an option contract, put option at strike price 120, expires in May, and I'm paying $630 for this option. So let's see what happens. So Apple option reaches $108. It starts to decline, and it reaches $108 on April 10th. So what can I do? It went way under 115, which was the sell-off price. So because it crossed 120 and went even under, it's in the money, I can exercise it. So I exercised it. Whoever sold this put option to me, that person have to buy my 100 shares at $120 because that's the strike price. Even though the stock is trading at $108, that person have to buy the shares from me at $120. So he's taking a loss. Okay, so I sell them at 120, so that's $12,000 I receive. But remember, I paid for that option, so 12,000, minus 630. So essentially, I'm saving a lot of money, even though the stock price is right now trading at a much lower price. I did not lose that much money compared to someone who did not hedge. If someone did not hedge, they would have experienced a 13.6% loss. But since I hedged, I only experienced a 4% loss. So that's how options can be very powerful to protect your investments in the event of a sharp decline in share price. Okay, so I did not show you how to sell a call or in what situation you'd sell a call. There are a lot of strategies. So obviously selling a call is a really good strategy. I use that. That might be my favorite strategy, selling calls. And then you can also sell puts, which I did not show. That is, so this one, sell call, is a bearish strategy, and selling a put is a bullish strategy. Okay, so if you want to learn how to do these and go through a very thorough example, click this. If you click here, it'll take you to a YouTube video, tutorial, all that stuff. You're going to be a master of selling calls and selling puts. Okay, so with that, I think this video concludes. I'm going to start adding more videos in this video series, which will take you through more specific examples, detailed examples of trades I'm making. For example, I am trading a certain stock, Palantir, very frequently, where I'm selling calls. So I'm going to take you through examples like that in the upcoming videos. So that is it. Thank you for watching. If you have any questions, let me know in the comment section. And yeah, as always, thank you for watching.